Hey, good morning again, options traders, and happy Monday to everyone. I hope everybody had a great weekend. And over the weekend, I got an email from one of our traders saying that he had watched some of the videos on rolling and thought it would be a really good idea to roll more frequently. And his premise was that he would end up with more money. And his question was really talking about rolling call options up, which is what I'm going to focus on for this video. But we could have the same question in reverse for rolling put options down. But the big question, does rolling your call options up earlier or more frequently mean that you're going to end up with more money? Well, it's a good question. Let's go find out more. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So before we get started, quick review for the people who might be new. Rolling up review. So remember, whenever you're rolling up a call option, it just simply means you're going to sell your current call, whichever one you currently own, and you're going to buy a higher strike call with the same expiration. And when you do this, the main reason for doing it is that you generate a credit. And that's because, as we've talked about before, that lower strike calls have to be worth more money than higher strikes. For the same expiration, they give you the right to pay less, which is an advantage, so we know they have to be worth more money. And if for some reason they weren't, it would create an arbitrage opportunity, which means that it would be free money for somebody out there, usually the algobots, but that would correct it. The arbitrage would bring these prices back in line. So we know for sure that lower strike calls must be worth more than higher strikes. So for example, let's say that you buy a $100 call, you pay $6 for it. And the stock price rises and you decide to roll to the 105 call. So the $100 call, the one that you own, is a lower strike. We know it's got to be worth more money. And so if you roll it, the easiest way to do it is to sell the 100-105 vertical spread. And that will generate, let's say, a $4 credit. Now, depending on where that stock price is, that credit could be much less, might only be 40 or 50 cents, and could be a maximum of 5, the difference in strikes. But a basic rule that I tell traders is to roll when you can receive about 80% of the difference in strikes. Just a rough rule of thumb. So if you sell your $100 call and buy the 105 call, again, it's a $5 difference. We take 80% of that $5 difference, and that comes up to 4. So again, that's just a rough rule of thumb to say that if you can sell this vertical spread for a $4 credit, then it's time to roll. Now, another part of the review, why would we use a vertical spread? Well, we do it to prevent execution risk. We want to get both trades executed simultaneously. So when you sell your $100 call to close and buy the 105 call to open, what you're really doing is selling the 100-105 vertical spread. So again, let's say that you're long the $100 call, and when you place this order to sell the 100-105 vertical spread, watch what happens when the order executes. You'll be long the 100 call and short the 100 call, so they just cancel. And now you're long the 105 call. You used to have the 100, now you own the 105. You have rolled that strike price higher. And the main reason for doing this, yes, it's the credit, but it's a risk management tool. So if you paid $6 initially, and if you get a $4 credit, you've now shifted this red line, this maximum loss down here at 6, up to a maximum loss of 2. And that's because you've collected a $4 credit. And if the stock continues higher, maybe you roll for another $4 credit, and now you're going to be up here at plus 2. So once you've rolled above 0, now you've received 100%, that full $6, plus an extra $2. You have a guaranteed return on your money of 1/3 or $2 on a $6 cost, but you still have unlimited potential upside. So that's the basic reasons for rolling, but now again, this trader's question was, well, shouldn't I do it more frequently? Why should I wait for a $4 credit if I can get a 50-cent credit? And if I can do this all the time, I'm going to end up with far more money. That's the question. Is it really true? Let's jump over to an Excel spreadsheet and take a look at some option prices. All right, so now we're into an Excel spreadsheet, and what I've done is I've generated some theoretical option prices. Now it's important to understand that for all of these prices, we're keeping the stock at 100. We're just looking at different strikes and what they would be worth with the stock at 100. And that's really what this person's question is. Now, of course, in the real world, stock price is moving, time is moving, but at any given moment in time, you have a stock price and you have a list of option prices on your broker's platform. So we're just going to make it simple by keeping the stock at 100 and looking at these different strikes. So with the stock at 100, you could see that based on the parameters I had in the pricing model, the $50 call was worth 50. So it's exactly trading at parity. The 55 call was 45.01, 60 call is worth $40.04, and so on. The at the money call is worth $8.39. So one thing we can do is to say, well, if you owned the 50 call and rolled to the 55, how much money would you receive? Or if you owned the 55 call and rolled to the 60 call, how much money would you receive? So we can do that in Excel by just putting an equal sign, and we're going to take the top number minus the bottom number. So yes, we would receive a credit of $4.99. So if I copy that down, it's going to do the same thing every time. So in this case, it's saying 45.01 minus 40.04. You would have a $4.97 credit. This number right here is saying if you own the 60 call, you could close for 40.04 and pay $35.13 and get a credit of $4.91. So the question again is, if we took all of these credits much sooner, as opposed to waiting for the stock to make a bigger move, are we going to end up with more money? So let's look at an extreme case. You own the $50 call and you roll it to the 55, yep, you pocket $4.99. You immediately roll it to the 60 call, you pocket another $4.97. You roll it to the 65 call, you pocket another $4.91. So if you were to take all of these rolls, these very small individual rolls, is it going to be better than, let's say, just rolling straight to the 100 call? So let's try it. I can say equals sum of all of these credits from those rolls. Yeah, you would pocket $41.61. But how much of a credit would you get if you just rolled straight to the 100 call? Well, you'd get 50 minus 839, and look at that, it's exactly the same. So no, you're not going to make more money by rolling more frequently. Let's try one more. Let's say if you took the sum of all of these credits right here, that would be $48.78. So yeah, it sounds like you're picking up lots of money by taking these very quick rolls. But if you had just taken one roll from the 50 strike down to the 130, it's exactly the same. So no, you can't beat the system. You're not going to get more money by just taking quicker rolls. Now, sometimes that's hard to see, but for the math people, it should be pretty obvious that you're just looking at the incremental or the marginal values, and they have to equal the same as the entire sum or the entire distance. So as a simpler example, just think of the numbers 1 through 5. Get away from option prices and making it mysterious. Look at the numbers 1 through 5. If we look at the incremental values or the marginal values, the difference from 1 to 2 is an increase of 1. From 2 to 3 is an increase of 1. 3 to 4, 4 to 5, they're all an increase of 1. So if I look at the total differences here, or the total steps that I've taken, there's 4. And that should be the same thing as if I just take 5 minus 1. If I just look at the extremes. That distance, 5 minus 1, has to equal the sum of all the steps. If it takes 4 steps to get from 1 to 5, you can't beat it. It's always going to be 4. So look at it another way. If I have $1 and I increase to $4, that's an increase of $3. And that's exactly the same number of steps that I took to go from 1 to 4. So that should be fairly obvious if you just think about it with just simple counting numbers, and that's all that's happening here. It just looks more complicated because we're using option prices. Now, what could be an argument for taking quicker rolls? Well, this is a bird in the hand. If you roll here, you've got $4.99 for sure, whereas if you wait for the stock to come all the way up here, it's not for sure. Now, I've talked about this in a previous video. If you're pushing the maximum value here, the difference in strikes, that's really becoming a danger. In finance, we call that a danger because here there's only one more penny you could make. That's the very best you could do from waiting, but you could lose $4.99. So that would almost force you to have to take that roll. Same thing here at $4.97 and so on. And that's really the basis for this 80% rule. So even here, if you can capture, that's roughly $4 for the difference in those prices right there, I would take that. But what a lot of traders are going to do, let's say if they buy the at the money, they're going to roll really every time they can get some kind of a small credit, thinking they're going to end up with more money. So if you start with 100 strike right here and you keep rolling, as we just showed, what's going to happen? If you take all of those rolls starting at 105, you're going to pocket $7.17. But if you just did one roll from 100 to this 130 right there, it's the same money. Now also keep in mind you're paying commissions every single time that you roll. That's another reason that these are not going to balance. You're going to be much better off waiting for these rolls. Again, all things equal, we have to be careful that we're not leaving too much money on the board. But the main thing to get from this video is to understand that it's not a good argument or a good idea to say, let me just roll as soon as I can because I'm going to end up with more money. That's just simply not true. Now we can also see that from the rolls, right? If we roll from the 100 strike to the 105 for a $4 credit, we've talked about this in previous videos. Mathematically, that's exactly the same thing as buying the 105 put for $1. You've absolutely shifted your break-even point out by $1. And so whenever you're rolling, if you're not collecting that full difference in strikes, which you're most likely not going to do because you'd have to wait until expiration for that to happen, or at least for the option to go super deep in the money, there's going to be an implicit cost. And so when you look at bid-ask spreads, commissions, and these implicit costs, it just doesn't pay to roll just because you can get a credit. So if you really want to make more money in the markets, understand your options pricing, and most of all, your rolling strategies. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.